This video and all other videos on this channel are for entertainment purposes only. The content of this video and all other videos on this channel are the opinions of the creator only and do not constitute legal, trading, investment, or financial advice of any kind. Investing carries a high level of risk and the majority of retail clients lose money. Do not invest any capital unless you understand the risks and you are prepared to lose it all. Alright, hello and welcome to Camel Finance. I'm your boy, Camel, and this is the weekend's deep dive. On the weekend, we like to come back and re-examine the base case hypothesis of the channel that we've held for well over 2 years now. And this week is no different. We're going to come back to this thing, reassess it, run through it from the top, and check to see if it's still going, largely speaking, according to plan. So without further ado, at the lows, the base case for the stocks was we were too bearish. We were going to have a blow off top to all-time high. We would then eventually top, come down in a global bear market and recession, and I was calling for this bear market and global recession to be deflationary. Fast forward to today, and the long-time viewers of the channel know that this is a pretty intense time for us. And I have long been talking about having 3 criteria that need to be met for me to call a top. That first criteria is a third angle violation. We have so far got that. As of this week, we have also got a second angle violation. The third criteria that I need to see for me to feel comfortable enough to call a top is a counter trend bounce here, out of a daily cycle low, and then a rollover and a failed daily cycle. Once we get that, I will be able to tick off all 3 criteria for my top call, and I will feel more than comfortable suggesting the top is in for this market and the bear market and global recession has started. There is still the potential for one saving grace here because we are due a daily cycle low any day now. We could indeed force a daily cycle low in here, rally up, and if we go straight to all-time highs, then we'll probably get long out of this low. We'll be able to say, okay, only 2 of my 3 top call criteria were met, and therefore I can't possibly call a top, and we will of course continue to conquer these markets in real time in front of everyone like we've been doing the whole way up since the lows. But we have finally reached that moment in time where once this daily cycle low forms in the next couple of days, and it will form in the next couple of days, that becomes my bull market invalidation. That becomes the line in the sand. That low we formed on Friday may well be it. We don't know yet, but if we get a nice big strong green Monday and Tuesday and Wednesday, then I'll have no problem setting that as the invalidation, and any trade below that low will be me calling a top. Now, I don't want to call a top, but the system is the system for a reason. So if you're bullish, if you want your assets to do well, if you don't want this party to be ending right now, then we really need to see this cycle low hold and not fail. I'll spend a little bit more time going over the cycles and a couple of scenarios we could see over the coming days and weeks when we get to the TA section at the end. But so far, the idea was we would have a blow off top and come tumbling down in a bear market. And so far, we have certainly had 3 increasing angles, which qualifies, at least to me, as a parabolic blow off top. And now we are breaking down of not 1, but 2 of those 3 angles. Dangerously close here to me being able to say that's it, the top is in. At least in the short to medium term, days to weeks, we should get some relief here before we then can even entertain the true downside scenario. So closer than ever. And as you're going to see when we get to the end, these lows for me are tradable to the long side. But again, we need to be really, really careful here going forward. The next idea of mine was that Bitcoin would do a similar thing. It would have a big parabolic blow off top. I was originally calling for this cycle to be left translated. However, there was a hard invalidation experience on this idea as we got to November. And therefore, the cycle can no longer possibly be left translated. And as such, I have moved and adjusted to the new data as it presented itself. And we are now working with this idea that we would have a moderately right translated or extremely right translated cycle. Each one of the prior weekly cycle lows has yielded, approximately speaking, a 100% rally out of the cycle low. We have now, I believe, found a candidate for a cycle low. And all we need to do is see this thing push up about 100%. And we'll be able to say, yep, cycles continue to do cycle things. Similarly to the stock market though, if this weekly cycle low resolves to a lackluster bounce, rolls over and fails, then again, I'm going to be forced to call an early top here. I'm going to be forced to say that that was the top for Bitcoin. And once more, similarly to the stocks, I don't want to do that. So really, really hoping both the stock market low and this current weekly cycle low for Bitcoin can hold here and we can indeed resolve to new highs across the board. It's not the first time we've been here. There's been a couple of times in this market where I've said, these levels need to hold or else, okay? And in the prior times, we resolved to new highs, we caught the longs, happy days, but we just so happen to be in a pretty intense time now where I think I'm going to be amongst the first people to call a top. I don't really see anyone else trying to call tops here just yet, apart from, of course, the people that have been perpetually calling the top the whole way up. Very, very strict criteria, very, very specific criteria. I've given you it a week in, week out, and now it's just a case of seeing what the market will give going forward. I still maintain both these lows for the Bitcoin and for the stocks are tradable to the long side, but again, we need to have hard invalidation levels going forward. As I said at the start, once this bear market and recession hits, I believe we're going to see a deflationary component. Largely speaking, this is because anything you do to the M2 rate of change shows up in the CPI with a lag. I've got an updated chart here that shows this. We are still hypothesizing this snapback right here in the M2 rate of change has yet to present in the CPI data, and thus we are eventually going to see this thing slip for a short period of time into asset price deflation. For the last few months, People have been mocking and jeering this idea. They've been telling me that we're no way getting deflation. The risk is inflation. We have been incessantly bombarded with people telling me that this was the base case and that tariffs were indeed inflationary and all of this kind of jazz. And I maintained that all we were seeing was a counter-trend wobble within the macro downtrend in inflation. And finally, okay, the chickens have come home to roost. This is no longer up for debate. This is no longer a point of contention. Everyone that was calling for this repeat, which was frankly very, very lazy analysis because the current macro backdrop is nothing akin to what we saw in the 70s, as I presented every week. And now finally, everyone that was calling for the resumption of inflation has been invalidated. We continue to move to the downside. Disinflation is still the risk, and ultimately a short period of asset price deflation is also still the risk. So that's another component we can tick off and say, yep, still going in the right direction. Again, if we're going to have a global recession and a bear market, we would of course expect to see labour market deterioration, and this continues to be another point that we can tick off as far as I am concerned. This week, we also saw the unemployment rate tick up to 4.1%. Non-farm payrolls came in below expectations, but above the prior readout. And again, if you know where to look, okay, the warning signs are there. This is U6 UR, okay? So this is the 6-month moving average of the unemployment rate. Tell me that this at the hard right edge does not look extremely concerning if you know what a recessionary lead-in phase looks like. Weirdly enough, the SAM recession rule printed a 0.27 on its most recent update, which somewhat contradicts this data set. However, the prior lower low sits at 0.2. So as it stands, still no lower low, still no change in structure, still no change in behavior, and thus this could still be a lead-in phase before acceleration, just like we see in all prior instances. We also make note here that the recent spike in US job cut announcements has been absolutely massive. The US-based employers have announced 172k layoffs in Feb, the most since the 2020 crisis. And this is a similar spike that we saw back during the 2008 GFC and the dot-com bubble burst recession. These lead-in phases before acceleration are what we talk about often here, and it seems to me that so far we can tick this off because, again, that is exactly what we are experiencing. We are experiencing labour market deterioration in real time. And once again, I repeat this every weekend, but I do think it's important. People are still out here parroting that 4.1% is historically low, when in fact, 5 out of the prior 12 recessions started at 4.1% unemployment rate or lower, with this one all the way back in the 50s starting at just 2.6%. Meanwhile, we continue to live through what I have been suggesting to you guys is one of the largest Fed blunders in history. Now, we can call it a Fed blunder. I actually think that a more accurate representation for what this is a controlled demolition. I do not believe the Fed are incompetent. I believe they are engineering a controlled demolition on purpose so that they can ultimately usher in CBDCs. You don't have to accept that. That's just my idea. That's just the way I see it personally. I'm not trying to sell you that as an idea or a narrative. I'm simply giving you my opinion. But the way I see it is, if I can see that this is overly restrictive, and of course it is because we've got labour market deterioration and inflation dropping like a stone, then we can easily look at this and say this is far too overly restrictive for the current inflationary and labour market conditions. And if I can see that, then I'm sure they can see it too. That's what makes me think they're doing this on purpose. I do not believe they are just purely incompetent. I know a lot of people like to think they're smarter than the Fed and think that they could do a better job than Powell, but I don't really think that's the case. I think they know exactly what they're doing and they're doing it on purpose. Whichever side of the fence you sit on, whether you think what I said is absolutely crazy or not, anyone with any kind of knowledge at all here understands that this is indeed still far too overly restrictive. And until such time as we start to continue to reprice this thing in favour of rate cuts, then we are going to continue to see the labour market deterioration and the inflation continue to drop like a stone. The Fed is significantly behind the curve now. We've been making this case for months, and ultimately this is going to start to have negative downside consequences for risk assets, just like we see in every other recession. And then, as ever, the Fed is going to be traditionally late, just like it always is, to start to cut, and it will eventually be forced to start panic cutting on the way down until eventually we get near ZERP again, where we can finally spool up the printers and launch some more QE. Something else that is not quite alarming to me just yet, but certainly on my radar, are the high yield credit spreads. We've been monitoring these week in, week out, and the compression has been real. Now remember, historic compression precedes historic expansion. We did get a little bit of a pop-up into resistance as of Friday's close. No sign just yet of needing to sound the alarm bells, but get a breakout here, and it's only reasonable for me to think it's going to start to spike, just like we saw back here in the C19 era, just like we saw back here in the GFC, and just like we saw back here in the dot-com bubble. So it hasn't happened yet. But if it starts to break out and the stock market, if it rolls over here after finding a daily cycle low and fails, I think given everything I've presented today, we can say these breakdowns in the markets are to be respected. Also this week, we saw the US GDP prediction drop from plus 2.3% to negative 2.8% in a single week, a revision of 5.1% to the downside. It finally seems like the chickens are coming home to roost on this call of mine. And every week we look at things like the deterioration in the housing market. We know this is back to the GFC levels. We know that the delinquency rates on commercial mortgage-backed securities, again, are at the GFC levels. We more recently got an existing home sales update, again, missing massively. We've been looking at credit card delinquencies up and to the right, rapidly approaching the levels of the GFC where things started to hit the fan. And on top of that, we've got even more updated data here because we can see Americans are falling behind on car payments now at levels that exceed the GFC and the pre-dot-com bubble levels. Americans are struggling, and remember, when the consumer is struggling, it has less money to keep the economy turning over, and this is the kind of thing we see as we head towards recession. The last thing we tend to cover here on the weekends is the yield curves. As I often say, everyone gets the yield curve wrong all the time. When we invert, everyone screams recession, and they're wrong. When we revert, everyone screams recession, and again, they are wrong because it is the acceleration to the upside as defined by weekly higher high and higher low closes that is synonymous with the tops coming in. Again, it is the acceleration in the yield spreads that sees the top come in. It is the acceleration that sees the top come in. And again, I suggest to you, not until we have seen acceleration here will we expect to see true technical breakdowns in the stock market. But if, as I said, we get this bounce out of here and it rolls over and fails, then we would largely expect to see this confirmed by a spike in the yield spreads. Zooming in and taking a look at the 10-2 yield spread, we currently have higher high and higher low weekly closes. However, I would not say this is accelerative enough yet for me to start to sound the alarm. We can, of course, continue to range sideways here. We could also roll over again to the downside, and none of that would be any kind of signal that could be interpreted as alarming. None of this would be synonymous with being able to call the top in the stock market or risk assets. But start to get a true accelerative period to the upside, start to morph into one of these prior accelerative looks that we've seen before, and historically speaking, you have very little time to react. So again, we must be watching for that failed daily cycle should it occur, and if it occurs, we would expect to see that on accelerative yield spreads. Now, if we change the 2-year to the 3-month, we actually get a much sharper signal, meaning you have far less time to react to breakdowns in the stock market once the 10-year, 3-month yield spread starts to accelerate to the upside. You can see here, we had 3 weeks of acceleration that perfectly aligned with the initial sell-off phase in the C19 plunge. You can also see back here, by the time we start to put in big accelerative moves, the top was already in the GFC. In the case of the dot-com bubble, by the time we started to get this accelerative move, again, you had just weeks to react to technical breakdowns before the market started to plunge what was ultimately over 50% top to bottom. So let's be clear. Right now, certainly no alarm bells need to be rung. Right now, the sharpest signal that I know of actually inverted again as of last week. This week, we are right around the zero line, getting ready to revert again. But again, I make the case that there is no need to sound the alarm until we see big accelerative moves to the upside. Right now, we simply don't have that, and we can continue to chop around in here or move down indefinitely. We can even continue to creep up slowly over time, and none of these things, to me at least, would be alarming. So at least we can breathe some sigh of relief here in the short term as we attempt to find some daily cycle lows in the stock market. But again, I suggest to you, start to see failed daily cycles, this thing will accelerate and we will have increased confidence that the top call signals are indeed to be respected. Now, the daily cycle low should be bottoming, and I've got a long position queued here because I do think this bounce is playable. However, again, once we get some kind of counter trend bounce and relief from here, we absolutely need to draw a line underneath the lowest low, the cycle low here, and use this as the line in the sand to call the top and the trend change and the reversal. Now, cycle theory says we should get at least a week or two of counter trend relief in the worst case scenario, and in the best case scenario, we might have actually just found a weekly cycle low. Now, I don't much like the idea of moving this to here. I think my original call that was the weekly cycle low was correct, but if what we see from here is a screaming upside rally that resolves almost immediately to new highs, then I think we can say that my initial call for this being a weekly cycle low was incorrect, and this was indeed the real weekly cycle low. On a balance of probabilities, however, it seems far more likely to me what we actually did was form a weekly cycle low and fail at the end of daily cycle 1 by closing a weekly candle body below the weekly cycle low. This has extremely bearish implications, and although there's only about 10 points in it, technically speaking, it is still a failed cycle. So again, we should see some counter trend relief here, okay? And I do think that is tradable to the long side upon confirmation of a daily cycle low reversal. But I still think this is pretty high risk because on a balance of probabilities, given that we printed a failed weekly cycle here, it tells us to expect something akin to this failure. And then of course, the top call should be acted upon. I really hope for Bitcoin's sake, what we see is a big swing and a reversal here. I really hope that we can close this upcoming week with a big green candle, something like this. That would give me a lot more confidence that I was actually premature in calling a weekly cycle here and would look, therefore, to see a weekly cycle low here. And that would speak to me that this was just a correction that's going to resolve to new highs. And most importantly, therefore, there probably is still space for Bitcoin to execute its double out of this weekly cycle low. But needless to say, if this daily cycle low is going to roll over and fail and confirm that I had the weekly cycle low in the first place correct, and thus the top call criteria has all been met, it's difficult for me to see Bitcoin rallying in the face of the stock market rolling over and breaking down. Tops in the stock market often take many weeks to work themselves out, and I think there was a chance when we started to top back here in October for Bitcoin to explode to the upside whilst the stock market entered distribution for a few weeks or months. But given that the stock market has been doing this for weeks and months already, I don't see that there's a great deal of time for Bitcoin to rally to new all-time highs just yet. I really think we need to see these lows hold. I really think that we need to not see any more failed daily cycles. And unfortunately, if we do, then I have to stick to my system and call the top. And unfortunately as well, that also, to me at least, speaks to perhaps expecting this current daily and weekly cycle to fail for Bitcoin. So hopefully that's not the case. Hopefully what we can get is a nice big green turnaround week this week. Hopefully those longs can resolve to new highs. Other than that, gold still working on a daily cycle low. We added to our silver position because we believe the daily cycle low is in for silver. Bitcoin has still yet to really do anything. I wouldn't say it's truly confirmed a new daily cycle just yet, but it certainly hasn't failed yet either. And notice how all of this is occurring on a Dixie that is coming off very rapidly, and the 10-year yield, the chart of truth, still, roughly speaking, following that, held that to the bond market squiggle. So it's going to be a wild week, I think. It's going to be very intense, but at least we know the levels, right? At least we have a system and we can stick to that system. I hope you found value here today, and I hope you can head into next week unbiased and open to all possible outcomes. I'm your boy Camel. Have a great weekend. Until next time, take care from me. All the best. Cheers. Bye.
Camel Finance, he's the man to see. Rocking the markets with his contrarian spree. Trades like a pro, no fear, no shame. Sticking to his guns in his money game.